Good morning, everybody, and welcome to our second webinar entitled Ready, Fire, Aim in FUG. I'm Claire Renska, Chief Investment Officer at 27 Investment Managers, and joining me is Nadir Token. The title of our webinar today really speaks to the current environment in which we are attempting to make good investment decisions. We're going to talk to some of the themes that we're seeing in the market and why it is such a murky picture that we're facing. So we'll talk through the slides. If there are any questions, please feel free to type them into the Q&A section on your screen, and we will answer questions at the end of the slide presentation. So the themes that we're going to talk to are really those themes that are clouding the current investment landscape. And while we never have perfect foresight, there's no crystal ball, we don't know what's going to happen tomorrow. The current environment is particularly uncertain given what's happening on the political front, as well as what's happening on a global scale in terms of the markets and unprecedented levels of central bank involvement in the market and how that's played out in terms of the pricing of assets. So the 5 themes we're going to talk to are political uncertainty, and that's very topical here in South Africa. We all know we're coming up to the ANC elective conference, and there's still a lot of uncertainty around the outcome. But this is also on a global scale where we've seen the impact of uncertainty around things like Brexit, around Trump's presidency, around the continuation of the European Union and how that's impacted the world. Then we are embarking now on a period of central bank balance sheet unwind, and we don't know how that's going to impact the markets and the pace at which that's going to happen. We know we've had huge levels of quantitative easing and money injected into the market, which has inflated asset prices and resulted in a search for yield. And how does that play out now when central banks look to start unwinding these massive balance sheets that they've created? Then locally within the South African equity market context in particular, NASPERS is something that we've all spent many hours talking about. And the concentrated equity market is a theme that we look at as well in terms of the construct of benchmarks and how this might have skewed the local equity market performance. What is positive worldwide is that we've seen global earnings tick up and they've been incredibly strong, which has helped to buoy global markets and has been good for performance of the global markets, as we've seen economic growth come through slowly as well as company earnings growth. And then the last theme we're going to look at is that around whether we are in a tech bubble, whether we're in bubble territory, whether the price of tech assets has been inflated, and how that possibly could impact the environment in which we're operating.
I think just to add to what Claire's already said, I think what's clouded the picture even more is that you can't consider each one of these 5 factors in isolation. So it's very much become navigating how do some of these factors intertwine with each other and how do they impact each other. So a very good example of that would be concentrated equity benchmarks and the Naspers issue in the local environment, and tech and the tech bubble, so theme 5 on the slide, and how those two have correlated with each other, and to what extent is Naspers run up just as a result of tech assets globally doing well, and Naspers becoming too big for the South African markets on the back of a whole lot of money just flowing to tech in search of earnings growth. So it's not just about considering these factors in isolation, but also how they interconnect and interrelate with each other, and that's what's being exceptionally challenging to wrap our head around.
So if we start with the political and macroeconomic risk, political tension has been rife both within South Africa and on a worldwide basis. And the biggest impact has been that it's created uncertainty. And if it's one thing that markets really don't enjoy, it is that uncertainty. So we've been looking at things and how they've unfolded and how they continue to unfold, and at our portfolios. And we want to be certain that our portfolios are positioned not for any one specific outcome, because it's impossible to put all your eggs in one basket and have everything positioned towards one specific outcome, because as we saw with the Brexit vote, as we saw with the Trump presidency, the outcome is never certain. But while the picture has been clouded, we've continued to see asset prices continue to rise, and we've seen bouts of uncertainty, especially within emerging markets, result in a temporary rush of assets to safe haven. But broadly, the search for yield continues despite the uncertainty in the market. Within the local context, some of the risks that we're looking to navigate, the chief one really continues to be what happens in December. What is the outcome of the elective conference? And the biggest impact with regards to the uncertainty that this has created is in both investor confidence and business confidence. We've seen business confidence at all-time lows. Companies are reticent to invest because the outcome looks so uncertain, and we don't really know what the future path that lies ahead is. So, as investors, we're not sure the path that the country is heading down. But as business owners, no business wants to commit capital when they're uncertain that capital is going to deliver good returns. This has also been clouded by a lot of the uncertainty around how the fiscus is positioned, the fact that there's a much bigger fiscal deficit than was originally thought, the fact that the outlook for unwinding that deficit and reducing government debt and even government expenditure is so precarious, given the position of the SOEs and their inability to be effectively managed, and those contingent liabilities that may well hit the government's balance sheet. But it isn't isolated to South Africa, because globally, the political risks come and go as well. So we saw many a headline around North Korea and the posturing between Trump and America and the North and North Korea, and talks about who was mightier and who had the ability to crush who. And that really raises investor fears around the world. We still don't know the outcome of Brexit, although the final bill apparently was negotiated. The UK is also on record as saying that they don't want to be responsible for footing that entire bill, and we see that there was no resolution around how the talks are going to proceed in the short term. I mean, Russia continues to be a risk on the horizon. There are Russian elections coming up, and it's pretty certain that Putin will continue in his current position. But what his greater goal is also uncertain. We've seen issues out of the Middle East, which has impacted the price of oil within the European Union. We saw the referendum vote within Spain, which has subsequently been cancelled. So there are a lot of different issues at play. We've seen a new governor of the Federal Reserve come in, which is going to have an impact as to how the Fed eventually does unwind their balance sheet. And not only do we see a new governor of the Federal Reserve, but a lot of the governors of the underlying state Federal Reserves have been changed and will change over the coming months. So there'll be a whole new guard in at the US Federal Reserve, and their stance and how they choose to unwind that massive balance sheet is also uncertain. We've seen the inability of the German government to form a coalition government, and that outcome also remains precarious. So there are a lot of issues that are clouding the horizon, even though the uptick in global earnings has been good. The geopolitical scene is still very uncertain and incredibly difficult to navigate. And the way we're focusing on things and looking at these risks is to make sure that we're not positioned for one specific outcome, that our portfolios are unlikely to be blindsided by an outcome that we didn't foresee, or a risk that we weren't aware of, that we're not positioned in one specific binary.
Yeah, if I can just add to that, I think what's made this part of, because people will say, well, there's always been political uncertainty. What makes this time different? I think what makes this time different is that traditionally how political uncertainty worked is that the markets typically priced it as an emerging market problem. So you had the risk-free rate, which was derived from the US or from the European Union or from the Japanese yield curve. You added some spread for emerging market risk or additional return you need to earn from emerging markets, and you use that as your discount rate when calculating the intrinsic value of an emerging market asset. What's changed this time is that, yes, there continues to be political uncertainty in emerging market, but that risk-free rate continuously moves because the political risk is abound across the developed markets as well. So, that risk-free rate and what's the appropriate risk-free rates that, given what central banks are doing, given all the political risk we're seeing unfolding in the global economy, and, that risk-free rate moving in leaps and bounds depending on what investor sentiment is globally, that risk-free rate is no longer stable, but the goalposts continuously change. And I think, that has drastic impacts in terms of fair value of assets globally, because it changes your discount rates and your risk-free rates depending on what investor sentiment is doing.
So it's important to understand the impact of all of these risks and how they could impact the portfolios. So, some of the risks that we need to be aware of is that SA-centric risk can definitely impact both the bond market in South Africa as well as the equity market. Cash will continue to be stable and to provide some level of protection, as possibly will hedge funds. But at the same time, if we head into a period of inflation increasing at a rapid rate, we need to be cognizant of the purchasing power of investors' money, and that cash isn't necessarily going to generate you inflation-beating returns. But a negative outcome in December could see bond yields spike, while equity markets, especially local counters, could come under significant pressure. A weakening rand would be good for the rand hedge stocks, as well as the offshore allowance in portfolios. And given strong global earnings growth, it's been a good place to look to generate returns, has been the offshore market and maxing out that offshore allowance. Emerging market risks can be country specific, but we've also seen that issues within Turkey and Venezuela have had an impact on both our local currency and our bond yields. So while the decoupling of emerging market countries can be seen to happen, I think the fact is when there is a risk of trade, that EMs then all get put into the same basket. So we need to be cognizant of that. And then I think US political risk likely would be negative worldwide. But the specific factors and the specific risks may impact different areas of the portfolio differently. And then Europe has started to show much better growth, and we've seen that while European stocks have lagged US stocks quite significantly, we're now starting to see better performance out of the European markets, but that obviously will be contingent on things within Europe stabilizing and a clearer picture going forward. In terms of understanding, what we need to be aware of and how we generate returns in a very uncertain market. I mentioned that we have looked to maximize the offshore exposure, but it's also important that this offshore exposure has continued to be diversified both across emerging markets and developed markets, and doesn't take any specific bet with regards to one region or one country. We also have a tilt towards more value, both in the local equity allocation and in terms of the global allocation, because ultimately risk is the chance of an impairment of capital, and what's most important with regards to that is what you pay for an asset. So provided there's a good margin of safety, your portfolio will have some level of protection. And then although hedge funds didn't have a very good 2016, we would hope that the managers are better positioned, have less concentrated views in their portfolios, and that hedge funds can be used, particularly in the institutional portfolios, to provide a level of protection to equity exposure.
Yeah, and I think we've really seen that come to bear thus far in 2017, where hedge funds have behaved a lot better and a lot more as they should, instead of all crowding into the same trade and thus heightening risk. They have a more diversified set of ideas in their portfolio, and we've seen returns drastically better in calendar 2017 after a really difficult 2016.
So what happens if we get the picture wrong? If the outcome that we think is most probable doesn't come to bear? Well, I think the key here is to remain diversified, to have exposure across asset classes, to not have directional bets in terms of any one asset class, any one sector exposure, to remain exposed to different manager styles as well. Where we can, we've hedged currency exposure so that we protected should the currency strengthen. The currency hedge will protect the position. If the currency weakens, the offshore assets will deliver stronger performance. But very important again is making sure that we're not overpaying for any of the positions that we have, and that we are positioning the portfolios and sizing the positions correctly. The next theme to talk to is really the pace at which banks scale back their balance sheets. And although we know we are moving from the period of quantitative easing, QE, to the period of quantitative tightening, QT, the acronyms continue. We don't know how long that path to a level of normalized balance sheet and normalized rates will be. The unwind could be very long and slow and protracted, especially if inflation takes a while to come through in the US market and Europe and Japan. But if it comes through quicker than expected, that path could be a lot quicker than the market is pricing in. So central banks have typically been quite good at providing guidance, but I think even the central banks don't really know the pace at which the unwind is going to happen and the complete impact of that. So we need to monitor those assets that will be most heavily impacted by this. And because we're a small market in a much bigger global environment, our local market isn't going to be immune to what happens on the global stage.
I think the important thing now is no longer the market has made peace with the fact that tightening is going to happen. It's no longer about is tightening going to happen or not happen. It's about the pace at which it happens now. And any potential indication that pace is going to increase, that or decrease. That's what the market is going to react to. And I think it's also about at the end of the day, yields have been excessively low for a very long period of time. And, as investors continue, or if investors continue on their search for yield, that could also impact the picture, particularly for a small open economy like South Africa, where, if the search for yield continues to remain abound, then the quantitative tightening won't really matter all that much, and there'll continue to be demand for emerging market assets, and we'll continue to see these yields being pushed lower, irrespective of fundamentals. But on the contrary, if there's no longer a search for yield because the quantitative tightening is happening a lot quicker than is what expected, and investors can get a decent risk-adjusted return in US Treasuries or in EU bonds or corporate bonds in the developed markets, we could see strong outflows from emerging markets, and that obviously impacts things like the currency, our bond yields, and a big portion of the portfolio, which is exposed ultimately to South Africa Inc. So what we've charted over here is basically the size of all these central banks' balance sheets. And what we very clearly see is the downward trend. And this was the point we made earlier about the fact that, that it's no longer about is quantitative easing happening. In fact, you can see the US has actively started tightening monetary policy rather than just slowing down the rates of accommodation. And I think that's quite an important picture to note. That tightening has happened. If Jerome Powell and the new leadership at the Federal Reserve continue along the communicated path, it could continue to be business as usual, and strong demand for yielding assets given the low interest rates. Although if the new Federal Reserve leadership looks to leave its mark and we see interest rates going up quicker than what's expected, which could be an outside risk, we could see a strong reversal of those flows. And what we've charted here is just basically to provide an indication of just exactly how vulnerable a small open economy like South Africa is to these events at the Federal Reserve and basically global central banks, where what we see is the dark brown and the light gray bars are basically flows into our net flows into our equity and bond markets. And basically, when we see big flows into our bond market, we see a strong strengthening of the rand. And when we see big outflows from our bond and equity market, we see a sharp depreciation of the rand. So, if these foreign flows were to reverse, the rand could come under sustained pressure, which obviously impacts inflation, impacts the discourse for interest rates, impacts local versus rand head stocks on the JSE, and obviously also impacts, the offshore allocation within portfolios given a weakening rand. And what's been driving a lot of this is, as we mentioned, this global search for yield. So essentially what you see on this chart is that green shaded portion is the inflation adjusted yield spread between what you can get in South African bonds and what you can get in the so-called risk-free asset, which is US 10-year treasuries. And every time this spread gets quite wide, we see strong inflows into our bond market. We see yields compress quite a bit. We see the rand strengthening. And where we are currently is, particularly after the medium-term budget policy statements, where we saw our yields kick up quite a bit, is that yield spread continues to remain attractive in South Africa. So, events like the ratings downgrade from S&P to junk status, that had very little impact on our market because of this yield spread argument, because junk is already priced in. So even though there is this underlying rhetoric of a tightening of monetary policy, we'd be best served to remember that it's ultimately yield spread that matters. And that's essentially what we've been doing for the last 18 months, is trading the bond market a lot more actively, and looking to pick up more fixed income exposure as the opportunity has presented itself when the margin of safety is bigger and yields kick up quite a bit. Interestingly, to add to this debate, there's something like $1 trillion of emerging market debt which expires in 2018. Now, that's obviously quite a significant event, because yield-hungry investors have essentially been able to park cash in these investments for the last 10 years, and on average earned around about a 7%, or between a 6.5% and 7% return if they reinvested their coupons for the last 10 years. Obviously, significantly higher than what they're able to achieve in developed market fixed income instruments. So with that expiring, it's obviously complicating the picture a little bit. In terms of, I think we've discussed already a lot of what we discussed on the slide. I think ultimately what we need to be careful of is that foreigners own 40% of our equity market, foreigners own 40% of our bond market. So developments on monetary policy globally, whether it be in the US or other developed markets, has a drastic impact in terms of the flow of capital globally. South Africa is obviously impacted by this, and it's a risk that we need to keep our eye close on, given that if the tightening is quicker than expected, we could see big outflows. Although if the tightening is a very gradual path, that could be still quite positive for inflows into the South African market. And how we position the portfolio for this is that ultimately all fixed income exposure, particularly local fixed income exposure, you don't want to be exposed on just one part of the yield curve, because, what the Federal Reserve does is, still up in the air very much, especially with a change in leadership. So you want to be well diversified across the curve. And what we've put in this graph is a typical fixed income, duration exposure in one of our typical balanced funds. And what you'll notice is that we're well diversified across the long part of the curve, the short part of the curve, and mandates which have the flexibility to switch between different parts of the curve depending on where value presents itself. And I think, if we misread the situation and, if we position for faster than expected interest rate increases or slower than expected interest rate increases, ultimately, we're well diversified in our fixed income building block. We still have significant exposure to fixed income assets to locally and globally in the global space, just in the emerging market space where the yields are a bit more attractive and the yield spreads are still quite high. And if quantitative easing continues into the foreseeable future and central banks reverse on their rhetoric, ultimately that's going to be very, very positive for global equity markets, as we've seen for the last decade. So our equity exposure across the funds will pick up on that.
concentrated equity benchmarks is the next thing that we look at, and there has been a considerable amount of debate within the market around what is a sensible benchmark and the weighting that Naspers currently has as a percentage of the JSE's market cap. And what we've seen this year is that performance of equity markets has largely been dominated by Naspers, not only because it's performed incredibly well, but because of the size it has within the market. But, you know, the ongoing delivery of earnings growth within the counter has vindicated managers who've had large positions within the stock. So it's been a case of a virtuous cycle where, you know, managers have had large positions in the counter because it's done well, it's performed well, and the earnings growth has been there. And the future possibly remains very, very bright for the stock as well as for Tencent as one of the main drivers of performance, given especially what's happened within the tech sector globally. But the biggest question and the biggest issue to consider is, what is a well risk managed position to hold in the counter? And here portfolio construction is the key. It's not about what is the outlook, how well is the stock going to do, how much value is there to be unlocked. It's about what are the risks facing being a single, you know, having an allocation to a single stock. What are the risks that face those businesses, and what happens if it goes wrong? So what's priced in and what's a sensible allocation?
Yeah, I think you know, we've broadly spoken to a lot of the factors on the slide already. But just to put into context, you know, the extent of the concentration we're talking about. I mean, Naspers alone now accounts for 23% of the Swiss benchmark, so almost a quarter of the benchmark is made up of one stock. And if you add in the other 4 Rand hedge stocks, you know, large Rand hedge stocks being Richemont, British American Tobacco, and Bidcorp into the equation, you know, those 5 Rand hedge stocks essentially make up 35% of the total Swiss benchmark. So you've got a benchmark where you know, a big part of the prospects for returns from that benchmark, 35% of that is made up of pretty much one risk factor, and that's what is the currency going to do over the foreseeable future. You know, we found that using benchmarks like the cap Swiss index rather than the full Swiss index does partially resolve some of these issues, you know, given that individual counters like Naspers is capped at 10%. That's the maximum position size can be in the benchmark. But ultimately, in a year where returns have been very concentrated amongst this grouping of 5 stocks, in excess of 75% of total market returns driven by the 5 top performing stocks this year, you know, it's the cap Swiss versus full Swiss argument becomes an argument of, you know, quite a big difference in return for these 2 benchmarks, and that's just something that we need to be cognizant of. So essentially, you know, obviously the part of the portfolio that this directly impacts is the actively managed equity mandates. You know, and I think the bottom line here is that it's quite important because equities ultimately make up a big portion of any balanced fund, given that, you know, this is the part in terms of asset allocation, this is the asset class which is supposed to generate inflation-beating returns over the long term. And those inflation-beating returns over the long term assume some level of real return from the equity markets. And, you know, but typically that equity market real return was driven by a number of differentiated sources of return. So it wasn't driven solely by a handful of counters. Now, in an environment like we've had this year, where, you know, that equity market has been very, very concentrated, it becomes difficult to quantify and understand, you know, what sort of level of real return are we going to get from this changing beast over the short to medium term. I think, with regards to this slide, while a lot has been made about Naspers this year and the opportunity set within Naspers, what the market has completely forgotten about is that the valuation discrepancies on the JSE have still remained quite wide. So, the gap between the most expensive and the cheapest part of the market is still at one standard deviation or slightly above one standard deviation now away from its long-term average. And what that ultimately means is that there's a lot of value to be extracted from being tilted towards value as a style in the local equity markets. And when this value unlock comes through, either by the expensive part of the market derating or the cheap part of the market re-rating, there's quite a lot of alpha to be captured in that scenario, where you've had such a concentrated return globally. So, or locally rather, in the local equity market. So, I think the message we're taking away from this is that we're finding quite a lot of opportunity in the local equity market, just not within some of the big counters within the local market, which has already run significantly and contributed the majority of the returns thus far. I think having mentioned all of the factors that we just mentioned, I think there's no doubt that Naspers continues to be a very, very attractive opportunity. There's no doubt about that. And, it is reflected within equity building blocks across the business. At a 13% weighting of the equity building block, we are expressing a bullish view on the stock. I think the point we're making is that we're just doing it within a risk-sensible way and within a risk-controlled way. But unfortunately, trying to control for that risk and trying to manage for that risk so far this year hasn't necessarily been the right thing to do from a return perspective, given how concentrated the market is towards just this one factor. So I think the message we want to leave you with is that we're very well diversified in our equity building block. We hold a significant amount of Naspers at 13% of our equity building block, acknowledging the fact that the growth opportunities there are phenomenal. In fact, reporting results just last week, 65% increase in profitability quarter on quarter. And we obviously follow the Tencent story quite closely with 61% revenue, top line revenue growth in the third quarter before monetizing a significant amount of their assets. So, the opportunity remains very attractive and we remain with a significant chunk in the business. We're just finding a lot of opportunity in other parts of the markets as well. And we are allowing our active managers to express that view by including those in a risk-sensible way. And I suppose, that's the point we're making, is that we have to blend manager styles across a variety of styles. And we need to allow that active manager style to play out over time and back the active managers that we've selected. But, bearing that in mind, we're still cognizant of the fact that at some point, the cheap part of the market, the value end of the market will unlock a lot of returns. And at that point, we need to be nimble enough to recognize that and rotate the portfolio accordingly. So, we've chatted around a lot of this already. The bottom line is that in that blue circle we have circled over there, that's really what's driven returns so far this year. And the bottom part of that chart, all below, either in line or below the Capswix index, so basically what either added no value or detracted from value, that's some 6.5 trillion rand of market cap, which has essentially gone sideways to negative this year. And, it's quite a big assumption to make that within that 6.5 trillion rand of market cap, there's zero opportunity to be enjoyed. I think that's quite a drastic stance and quite an extreme view to be taking. And the positioning of our equity building block, particularly with an overweight towards value within the local equity building block, is essentially trying to incorporate that view in saying that value unlock must come from everything in line or below Capswix at some point later this year.
And also just to add there, if you look at two of the stocks that have done particularly well year to date, Anglo and Kumba, these were stocks in 2015 that very few managers held because the resource sector was so depressed, commodities had sold off so much. Just rewinding the picture a little bit, we saw talk about a possible bankruptcy from Anglo's and even questions around the future of Kumba, and what we've seen is those stocks having re-rated and performed incredibly well from being really unloved and not widely held in 2015 at all. So it's difficult to know what's going to be the next driver and which stocks are going to be the best performers of 2018. But if history teaches us anything, it's that you need to be well diversified, because we don't know what those star performers are going to be.
I think just as a reality check, we're saying, well, Naspers is 25% of the Swix index. What can we ultimately get as, in relation to, as opposed to just buying Naspers, what else can we get in the market? So if you take the market cap of Naspers, it's somewhere around the 1.4, 1.5 trillion rand mark. And in exchange for that, you can actually buy a diversified set of 44 companies, the entire food producing sector, the entire gold mining sector, the entire platinum mining sector, all hospital groups. I think you get the point in that there's a diversified set of 44 different companies with different drivers, different geographies that they're operating, which you can own, as opposed to owning just Naspers. And I don't think that tells the full story. You've got to also look at what's the earnings of those 44 stocks relative to the earnings of Naspers. And well, those 44 stocks generate something almost 6 times the amount of earnings that Naspers generates. So again, I think it's important we stress Naspers, we do think is an attractive opportunity, but in a well-controlled, sensible risk allocation environment. You cannot be allocating 25% of your equity building block to an opportunity that has 1/6 of the earnings base of 44 other diversified opportunities. In terms of, I think this slide sums up quite efficiently what's been wrong with the equity market this year. So we've basically taken the general equity category, unit trust category, because that's the most publicly available information. And we've said who have been the best performing equity funds so far. And what you'll notice there is that of the top 25 performing equity funds year to date, more than half of them are constituted either large cap funds, so will obviously hold a big portion in Naspers, or purely passive funds. And I think the point we want to make here is that, style blending and understanding a manager's styles and diversified sources of return is not what has driven equity markets this year. It's all been about, have you owned the index heavyweights, and those index heavyweights constituting a large portion to returns. And I think as a multi-manager and as a risk-controlled environment, you want to access multiple sources of diversified returns over a long period of time.
The next theme really is global earnings, and what we've seen is that they've been on a much improved trajectory. So the US was the first leader in terms of a market recovery, and we've seen very strong earnings out of all sectors in the US, and the momentum shifting to other geographies as well. So, reported earnings have come in line with analysts' expectations or beaten analysts' expectations, and that's driven equity markets worldwide, and has been coupled with an improving outlook for economic growth as well. So, while the US was the initial beneficiary, this has spread much wider and has been very positive for the offshore allocation allowed in the portfolios.
I think, what we wanted to chart here is that ultimately what central banks have been on a big drive to do is improve or increase inflation globally, because basically very low levels of inflation or deflation, it disincentivizes investing, it disincentivizes saving, or rather it disincentivizes consumption, and it disincentivizes investment. So as inflation improves, people consume more, companies invest more, and there's this positive reinforcement cycle for economic growth, and consequently a knock-on impact onto corporate earnings as people consume more and companies invest more. The point we're making on the slide is that the inflation picture, although very, very sluggish to improve, has started improving, across the board globally, led by the US over the course of the last couple of quarters, with Europe and Japan very much slowly starting to come to the party more recently. And what this increase in inflation has ultimately done has resulted in improving earnings prospects for these global equities. So what we see over here is that the expectation for global earnings growth continues to be revised higher across the board. Perhaps the most encouraging has been the increasing earnings growth in emerging markets, but the US and Europe, particularly coming to the party now in terms of that earnings growth. And I think that's the critical component to maintaining the equity market rally. A lot of the questions we get asked is that, has the global equity market run too hard? Are we due for a sustained correction? And I think the answer, because multiples are at a premium relative to the average. And I suppose the answer to that question is that as long as earnings growth continues to come through, and as long as the global bond market remains as expensive as what it is, and equity or risk-free return hurdles remain so low, there could be an ongoing sustained rally from the global equity markets. And the next leg up from this point is no longer just interest rates remaining depressed, but also the earnings growth story starting to come through. Global corporates are on a big investment drive over the course of the last couple of quarters. We've seen corporate cash balances in the US come from just under $6 trillion to around $4 trillion. We've seen share buybacks have been slashed in half over the course of the last 12 months, meaning that companies are no longer buying back their shares to boost earnings per share growth, but they're actually investing in opportunities, doing merger and acquisition activity. And that's what's going to drive ultimately top-line revenue growth, which will filter through into earnings growth and sustain global equity multiples into the foreseeable future in our view. In terms of how we position for this, obviously, we maintain our considerable overweight to global equities, which we've had for a while, which has contributed phenomenally well to performance so far this year, and we believe will continue to do so. And in addition to that, our offshore allocation continues to remain fairly well diversified across a number of opportunities.
I think the risk to this view is that what we haven't yet seen is marked growth in real wages. Real wages have continued to remain very depressed. And in fact, real wages are at the same levels they were back in the 1970s. So in order for there to be continued sustained true growth, we need to see that real wages grow, because that will ultimately drive consumption, and many of the developed markets are very levered to consumption growth increase, or to consumption increasing for their growth. So that's the one key metric that we need to keep an eye on is there an increase in wage growth, and does that then filter through to a better increase in the inflation rate. So the positioning is not without risks, but we do have an allocation to the cheaper end of the market. We are aware that we need to be positioned in both the growth assets, but also those assets that still show value, and where we're buying them at a considerable margin of safety.
I think this is quite an interesting chart because, even if we're saying, unlike the local equity market where concentration remains very, very high, globally, even if there's a chance that we're wrong in terms of saying that global earnings growth is on an improving trajectory and this is going to sustain multiples. We can actually actively harness the benefits of style diversification globally, which has been quite challenging locally. And what this chart shows is that, the concentration between various investment styles. So basically, the lower the score, the lower the concentration, the lower the score, the bigger the underweights, and the higher the score, the bigger the overweights. There's no major overweights or underweights within the global environment. So there isn't highly concentrated sources of return here. And as a result of there not being highly concentrated sources of return, you can actually build a very well-styled, balanced equity building block with different components of the market contributing to returns at different periods in time, but not overly dominating, the return of the composite global equity building block at any one point in time. So I suppose the point of the slide is maximum diversification benefits over time.
Bitcoin is on everyone's minds. It's in the media almost on a daily basis, along with news of the FANGs, so Facebook, Amazon, Netflix, Google, which is listed as Alphabet. So a lot of talk around new tech. The world is changing. It definitely is. But are the tech stocks getting ahead of themselves? Has the market entered a stage of euphoria where all these companies are just priced for perfection? So, the way we're positioning the portfolios and in our discussions with our underlying managers is to take a pragmatic view, to not be out of the sector completely, but to take a balanced approach to having both the new technology stocks in the portfolio as well as old economy stocks, because both businesses have value and have the potential to deliver underlying earnings growth.
I think what we're showing in this chart is that there's obviously, as Claire mentioned, there's been a lot being made of Bitcoin recently, and a lot being made of, well, why don't we own Bitcoin? Or, why is Bitcoin not part of our portfolios? And I think this is quite an interesting chart from the FT. And, they've tracked basically how has Bitcoin progressed relative to your typical bubble, and it's almost gone exactly in lockstep with how a bubble would behave. We're now probably at the new paradigm phase, where Bitcoin is going to be the future. It's the new currency. It's going to, completely replace how currencies are viewed globally. And, that's why we see it continuously hitting all-time highs. We've seen bouts of bouts of fear where it's corrected quite a bit and then a return back to the normal. But ultimately, it's followed the typical path of what a bubble has been. And if we're going to extend this analogy one step further, I suppose what differentiates speculating from investing is, with investing, there's a good understanding of the drivers of return, there's a good understanding of the cash flows, and there's a good understanding of what's a fair price to pay given the earnings base and given the earnings growth levels. With Bitcoin, it's very difficult to establish all those variables. So it's very difficult to have a good understanding of what intrinsic value is. So buying the asset is simply speculating that the price will continuously go up. Obviously, it's not just been Bitcoin which has benefited off this tech rally. We've seen, a substantial rally, in anything internet retail related or anything internet tech related on global stock markets. So whether this been the FANG stocks, whether it's been the Chinese internet stocks in Tencent or Alibaba, whether it's even been locally in terms of Naspers, which is obviously driven by Tencent. We've seen a massive run-up in anything internet-related so far this year. And what we've charted over here is just how internet retail has fared relative to old-school retail so far this year. And we see a significant outperformance from internet retail. So, the run-up in tech has not just been limited to things like Bitcoin or esoteric instruments such as those. It's also filtered back into stock markets globally, and obviously had quite a big impact on performance. We've chatted extensively around Naspers already, but this is basically how Naspers has increased in terms of the weighting in the Swix index over time. So basically the local environment not immune to this pervasive theme of tech doing well globally. And are we overpaying for tech at the moment? I suppose that remains the biggest question.
And again, it comes down to being diversified, to understanding what's in the portfolio, what is the margin of safety in that particular asset or country or asset class, and making sure that although we're not missing out on the run up in the sector, we're also sensibly positioned and have allocations to other assets where they may be unloved, undervalued, and have a bigger margin of safety. So, whether or not this is a tech bubble and it ends in tears, we can't say. Whether this is just a reshuffling of the sectors to reflect a changing world and a changing environment, we also won't know. But the thing that we need to remember and to be positioned for is that we have good diversification across managers, across sectors, across geographies, and that we're aware of what we're paying for assets, and that we're not overpaying for anything specifically.
Yeah, and I think the second point to make is the last bullet point on the slide. I think it's even within the tech sector, it's very important to be able to differentiate between the different types of technology. Not paint everything with the same brush. There are actually companies in there which are highly cash generative, highly profitable, and continue to grow at a fairly rapid rate. And you have to differentiate those from the platform technology businesses, which are yet to generate any profits, which are generating significant losses, in fact, requires large-scale investments, and are basically just on a trend to be gathering users without any promise of when they're going to actually monetize those users. So I think even within tech, it's important to differentiate between the opportunities and understand which style would own what opportunity, because there's quite a big difference in variation within that category. I think, in terms of how we position for this, as Claire mentioned, just a sensible position size to continue to benefit from the sector doing well. Chatted extensively around NASPAs, where a composite equity building block in our portfolios have around 13% in the stock. And in terms of the offshore building block, obviously less concentration issues there, but still around 2.5% of the global composite equity building block in what's classified as the FANG stocks. So still a sensible position size, will benefit if the sector continues to do well, but won't completely implode the portfolio if sentiment turns and investors get tired of waiting for profits and actually want to see earnings delivery. So as I mentioned, just a well-diversified, sensible position size within something that's obviously quite attractive.
So those are really our 5 themes and how we're trying to navigate through this heightened uncertainty. It's, as I mentioned earlier, it's never with certainty, but we seem to be in a period that has heightened amounts of uncertainty, both locally and globally. So, we continue to monitor the risks, to understand the portfolios, to make the best decisions we can with consciousness of the risks that we face in our positioning. Markets move in cycles, and although we can never know the length of each cycle, we know that ultimately there is always an end to every cycle, and that things change. So we continue to be aware of the risks, to not overpay for assets that are in the portfolios, and to really let risk management be our compass and our guidance in these times.
Yeah, just in terms of taking questions just before we wrap up, we've got a question. What do you make of the risk being presented by governance and questionable management at NASPAs, and how that impacts the outlook for the stock? So, I think this is quite an important point to be made. In terms of this is exactly it's and the point we want to make here is that there are many potential banana peels for a rapidly evolving space like the tech space to potentially slip on, and for Naspers or Tencent or one of the assets within the rump to potentially fall short. There are a number of potential banana peels. I think the important point is that it's not our job to identify what exactly is the banana peel. At the governance issues and management issues weren't really on the radar of the average investor up until 2 weeks ago in the stock, and yet it's on the radar today. I think our job is to identify that there are a number of potential banana peels, and how do we position, given that there are these potential banana peels that we can slip on. And, this is the point we make about over-concentration within one stock. In terms of how the story plays out, there's a lot of uncertainty. We're yet to know how it will play out. What we do know is that there's significant value in the rump, given what it's currently valued at. Yes, there's a number of businesses in that rump which are unprofitable at the moment, but the early stage tech investments, they're not going to be profitable. OLX, for example, still shows very, very strong revenue growth from the latest earnings announcement. OLX in particular is forecast to reach profitability by the year 2022. So we believe that gradually, as the losses in these investments are cut, and as the development spend in a number of these assets are cut, we don't think that the rump is worth minus 650 billion rand. I suppose that's what I'm saying. That's an excessive negative valuation given there. But again, in terms of the management issues, that will play out over time. And I suppose how we manage for that risk is not be overly exposed to that single opportunity, which is what you are doing when you have 25% in a stock, whether it be through a passive investment or an active investment who's neutral on Naspers.
So, the stock has always been one that has had no voting rights for ordinary shareholders, which in and of itself is a governance issue. But, we haven't seen that really flagged until the recent headlines with regards to the multi-choice business specifically. So what it highlights is that within every company, there are company-specific risks, and the more exposed to a single stock you are, the more exposed to those company-specific risks you will be. And it comes down to you have to manage your position sizing. And the golden rule about building a portfolio is to make use of the benefits of diversification. And for a benchmark to be considered an appropriate benchmark, it needs to be well diversified. So those are all of the risks and the questions that we grapple with and have to understand how they impact the portfolio.
Good. Well, I think we're out of time. So that's where we'll wrap up. We just want to say thank you to everybody for joining us. Thank you for your ongoing support. If you're traveling over the festive season, please travel safely. And we hope to chat to you again early in the new year. Ciao, everybody.
Thank you. Bye.